Question 1. Which of the following describes the risk that an issuer of a bond may be unable to make timely principal and interest payments? A. Interest rate risk. B. Inflationary risk. C. Liquidity risk. D. Credit risk. Answer, D. Credit risk. Credit risk, also known as default risk, is the risk that an issuer will be unable to make interest and/or principal payments when they are due. This risk is a primary concern for bondholders, as it directly impacts the safety of their investment. Investors should assess the creditworthiness of an issuer before purchasing their bonds, often by reviewing credit ratings provided by agencies like Standard & Poor's or Moody's. Question 2. A customer holds 100 shares of XYZ stock. XYZ declares a 2-for-1 stock split. Immediately after the split, the customer will hold A. 50 shares at twice the original price per share. B. 200 shares at half the original price per share. C. 100 shares at twice the original price per share. D. 200 shares at the original price per share. Answer, B. 200 shares at half the original price per share. In a 2-for-1 stock split, the number of shares an investor owns doubles, while the price per share is halved. Therefore, a customer holding 100 shares will now hold 200 shares, and the price of each share will be approximately half of its pre-split value. The total market value of the investment remains the same immediately after the split, as the increase in shares is offset by the decrease in price. Question 3. Which regulatory body is primarily responsible for the enforcement of federal securities laws and regulating the securities industry? A. FINRA. B. MSRB. C. Federal Reserve Board. D. SEC. Answer, D. SEC. The Securities and Exchange Commission, SAC, is the primary federal regulatory body responsible for protecting investors, maintaining fair and orderly functioning of securities markets, and facilitating capital formation. While FINRA and MSRB also regulate aspects of the securities industry, they operate under the oversight of the SEC and are not the primary enforcers of federal securities laws themselves. Understanding the role of the SEC is crucial for grasping the overall regulatory framework of the U.S. financial markets. Question 4. An investor seeking tax-exempt interest income would most likely invest in which of the following? A. Corporate bonds. B. U.S. Treasury bonds. C. Municipal bonds. D. Mortgage-backed securities. Answer, C. Municipal bonds. Municipal bonds are debt securities issued by state and local governments to finance public projects, and a key feature is that the interest earned on these bonds is generally exempt from federal income tax, and often from state and local taxes for residents within the issuing state. Corporate bonds, treasury bonds, and mortgage-backed securities typically generate taxable interest income at the federal level. Therefore, for investors primarily focused on tax-exempt income, municipal bonds are the most suitable option. Question 5. Under FINRA rules, what is the maximum gift amount that a registered representative may give to a customer or associate per year, per person, without violating the gift rule? A. $50. B. $100. C. $250. D. $500. Answer, B. $100. FINRA's gift rule generally prohibits registered representatives from giving gifts of more than $100 per person, per year, to any person if the gift is in relation to the business of the recipient's employer. This rule aims to prevent undue influence or the appearance of impropriety in business relationships. While there are exceptions for occasional business entertainment, the direct gift limit is strictly enforced to maintain ethical standards. Question 6. A not held order gives the registered representative discretion over which of the following? A. Asset, action, amount. B. Price and time. C. Security, size, and side. D. Account and investment objective. Answer, B. Price and time. A not held order grants the registered representative discretion over the time and/or price at which to execute the order, but not the asset, action, buy, sell, or amount. This type of order is considered to be for a single trading day, and if not executed by the end of the day, it is automatically cancelled. It is a common misconception that not held orders grant broader discretion, but in fact, they are limited to only execution details. Question 7. Which of the following statements about common stock is true? A. Common stockholders have a guaranteed dividend payment. B. Common stockholders have preference over preferred stockholders in liquidation. C. Common stockholders have voting rights. D. Common stock is less volatile than preferred stock. Answer, C. Common stockholders have voting rights. Common stockholders typically have voting rights, allowing them to elect the board of directors and vote on major corporate policies, which is a fundamental aspect of their ownership. Unlike preferred stockholders, common stockholders do not have guaranteed dividends, and they are subordinate to preferred stockholders and bondholders in the event of liquidation. Common stock is also generally considered more volatile than preferred stock due to its direct link to company performance and market sentiment. Question 8. An investor sells 100 shares of stock short. This transaction means the investor A. Believes the stock price will increase. B. Has borrowed shares to sell, hoping to buy them back later at a lower price. C. Is selling shares they own from their portfolio. D. Is exercising an option contract to sell shares. Answer, B. Has borrowed shares to sell, hoping to buy them back later at a lower price. Selling a stock short involves borrowing shares from a broker and selling them in the open market, with the expectation that the stock's price will decline. The investor hopes to buy the shares back at a lower price later to return them to the lender, profiting from the difference. This strategy is employed by investors who are bearish on a particular stock and believe its value will fall. It carries unlimited risk because a stock's price can theoretically rise indefinitely. Question 9. All of the following are characteristics of an open-end mutual fund except A. They are actively managed. B. They have a fixed number of shares outstanding. C. They offer diversification. D. Their shares are typically redeemed at net asset value, NAV. Answer, B. They have a fixed number of shares outstanding. Open-end mutual funds continuously issue new shares when investors buy them and redeem existing shares when investors sell them back to the fund, meaning they have a variable, not fixed, number of shares outstanding. In contrast, closed-end funds issue a fixed number of shares through an IPO that then trade on exchanges. Mutual funds are typically actively managed, offer diversification, and are redeemed at their net asset value, NAV, at the end of the trading day. Question 10. Which of the following is considered an investment company? A. Hedge fund. B. Limited partnership. C. S corporation. D. Unit investment trust, UIT. Answer, D. Unit investment trust, UIT. A unit investment trust, UIT, is a type of investment company that buys and holds a portfolio of stocks or bonds, which remains fixed for the life of the trust. Unlike mutual funds, UITs are not actively managed and do not trade their portfolios. Hedge funds and limited partnerships are generally structured as private investment vehicles, while S corporations are business entities, none of which fall under the Investment Company Act of 1940's definition of an investment company in the same way a UIT does. Question 11. The primary purpose of a syndicate in an equity offering is to A. Provide research to institutional investors. B. Stabilize the stock price after the offering. C. Distribute shares to the public and assume financial risk. D. Manage the company's investor relations post-IPO. Answer: C. Distribute shares to the public and assume financial risk. In an equity offering, such as an initial public offering, IPO, a syndicate of investment banks is formed to underwrite the issue, which means they purchase the securities from the issuer and then resell them to the public. Their primary purpose is to efficiently distribute the securities and, in the case of a firm commitment underwriting, assume the financial risk of unsold shares. This process ensures that companies can raise capital from a broad base of investors. Understanding the syndicate's role is crucial for comprehending the primary market process. Question 12. Which of the following is typically a characteristic of a money market instrument? A. Long-term maturity, over 10 years. B. High risk and high potential return. C. Short-term maturity, 1 year or less. D. Traded primarily in the secondary market. Answer: C. Short-term maturity, 1 year or less. Money market instruments are short-term debt instruments, typically maturing in 1 year or less, issued by governments, financial institutions, and corporations to meet their short-term borrowing needs. They are generally considered low-risk and highly liquid, providing a safe place for investors to park cash. Examples include T-bills, commercial paper, and certificates of deposit, CDs. Their short maturity distinguishes them from longer-term capital market instruments. Question 13. An investor who buys a put option has a maximum potential loss equal to which of the following? A. The strike price of the option. B. The current market price of the underlying stock. C. The premium paid for the option. D. Unlimited, similar to selling a stock short. Answer: C. The premium paid for the option. When an investor buys a put option, their maximum potential loss is limited to the premium, the price, they paid for the option. Regardless of how high the underlying stock price rises, the option holder can simply choose not to exercise the option, thereby only losing the initial investment in the premium. This contrasts with selling a stock short, which has unlimited loss potential. Question 14. Which of the following is a common characteristic of most exchange-traded funds, ETFs, regarding their investment objective? A. They aim to provide investors with a guaranteed fixed income. B. They are typically passively managed and designed to track an index. C. They are actively managed with the goal of consistently outperforming a benchmark index. D. They primarily invest in high-risk, speculative assets to maximize capital gains. Answer: B. They are typically passively managed and designed to track an index. Most exchange-traded funds, ETFs, are passively managed, meaning they are designed to track a specific market index, sector, or commodity rather than actively trying to beat the market. This objective typically results in lower management fees compared to actively managed funds. While actively managed ETFs exist, the vast majority follow an indexing strategy. Question 15. Which type of risk is most likely to affect an investor holding a diversified portfolio of common stocks during a broad market downturn? A. Unsystematic risk. B. Business risk. C. Market risk. D. Liquidity risk. Answer: C. Market risk. Market risk, also known as systematic risk, is the risk that the entire market or a segment of it will decline, affecting most or all investments. This risk cannot be diversified away, meaning even a well-diversified portfolio will be susceptible to broad economic downturns or market-wide events. Unsystematic risk, business risk, is specific to an individual company or industry and can be mitigated through diversification. Understanding this distinction is crucial for portfolio management. Question 16. What is the primary role of the Municipal Securities Rulemaking Board, MSRB? A. To regulate the issuance of corporate bonds. B. To enforce federal securities laws related to all types of securities. C. To regulate broker-dealers and municipal advisors in the municipal securities market. D. To provide financial advisory services to municipal issuers. Answer, C. To regulate broker-dealers and municipal advisors in the municipal securities market. The Municipal Securities Rulemaking Board, MSRB, is a self-regulatory organization, SRO, responsible for regulating all firms and individuals involved in the municipal securities market, including municipal advisors and broker-dealers. The MSRB writes rules for municipal securities firms and professionals, but it does not enforce its own rules. Enforcement is handled by FINRA for broker-dealers and the SEC or banking regulators for others. Its focus is solely on the municipal market, not corporate bonds or broader federal securities laws. Question 17. When does a cash dividend become a liability for the issuing corporation? A. On the record date. B. On the declaration date. C. On the payment date. D. On the ex-dividend date. Answer, B. On the declaration date. A cash dividend becomes a current liability for the issuing corporation on the declaration date, which is when the company's board of directors formally announces its intention to pay a dividend. At this point, the company has made a legal commitment to its shareholders. The record date determines who receives the dividend, the ex-dividend date adjusts the stock price for the dividend, and the payment date is when the dividend is actually distributed. Understanding these dates is critical for investors tracking dividend income. Question 18. A customer wants to open an account that will be managed by a third party with full discretion. Which type of account would be most appropriate? A. Joint tenants with right of survivorship, STROs. B. Tenants in common, TIC. C. Discretionary account. D. Custodial account. Answer, C. Discretionary account. A discretionary account is the most appropriate choice when a customer grants a third party, such as an investment advisor or broker, the authority to make investment decisions without requiring prior approval for each trade. This requires a written power of attorney from the customer. While joint accounts and custodial accounts involve multiple parties or minors, they do not inherently grant discretion to a third-party manager. Understanding the need for discretionary authority is key to recommending the correct account type. Question 19. Which of the following terms describes the authority granted to a registered representative, rather than a specific execution instruction for a trade? A. Market order. B. Limit order. C. Stop order. D. Discretionary authority. Answer, D. Discretionary authority. Market, limit, and stop orders are specific instructions from an investor that dictate how and when a trade should be executed based on price and time conditions. In contrast, discretionary authority refers to the permission granted to a registered representative to make investment decisions, including timing and pricing, without prior client approval for each trade. While not-held orders, which grant discretion over time and price, are a type of order, discretionary authority itself describes the power given, not the specific instruction for trade execution in the same vein as market, limit, or stop. Question 20. Which economic indicator measures the total value of all goods and services produced within a country's borders in a specific time period? A. Consumer Price Index, CPI. B. Inflation rate. C. Gross Domestic Product, GDP. D. Unemployment rate. Answer, C. Gross Domestic Product, GDP. Gross Domestic Product, GDP, is the broadest measure of a country's economic activity, representing the total monetary value of all finished goods and services produced within its borders over a specific time period. It serves as a comprehensive scorecard of a country's economic health and growth. The Consumer Price Index, CPI, and inflation rate measure changes in prices, while the unemployment rate tracks the labor market, making GDP the most encompassing measure of overall production. Question 21. An investor owns a bond with a 5% coupon. If market interest rates rise significantly, the market value of the investor's bond will likely A. Increase. B. Decrease. C. Remain unchanged. D. Increase only if the bond is callable. Answer, B. Decrease. When market interest rates rise, the market value of existing bonds with lower fixed coupon rates will generally decrease. This is because newly issued bonds will offer higher yields, making older bonds with lower coupons less attractive unless their price drops to offer a comparable yield to maturity. This inverse relationship between interest rates and bond prices is a fundamental concept for bond investors. The coupon rate itself does not change, but the bond's value adjusts to reflect current market conditions. Question 22. What is the primary purpose of an initial public offering, IPO? A. To allow existing shareholders to sell their shares to new investors. B. To enable a privately held company to raise capital by selling shares to the public for the first time. C. To issue new debt securities to institutional investors. D. To offer additional shares of an already publicly traded company. Answer, B. To enable a privately held company to raise capital by selling shares to the public for the first time. An initial public offering, IPO, is the process by which a privately held company offers its shares to the public for the first time, thereby raising capital for growth, expansion, or debt repayment. It transforms a private company into a publicly traded one. While existing shareholders may sell some shares in an IPO, the primary purpose from the company's perspective is capital formation. Other options describe secondary offerings or debt issuance, not the initial public sale of equity. Question 23. Which of the following describes a red herring prospectus? A. A final prospectus used for selling shares to the public. B. An abbreviated prospectus used for short-term debt offerings. C. A preliminary prospectus used to gauge investor interest during the cooling-off period. D. A fraudulent document designed to mislead investors. Answer, C. A preliminary prospectus used to gauge investor interest during the cooling-off period. A red herring prospectus, also known as a preliminary prospectus, is issued during the cooling-off period of a new securities offering. It contains most of the information found in the final prospectus but lacks the final offering price and effective date. Its purpose is to gather indications of interest from potential investors without constituting an offer to sell, as sales cannot occur until the registration is effective. It is distinctly not a final selling document or a fraudulent one. Question 24. Which of the following fee structures is common for mutual funds and represents the annual cost of operating the fund, expressed as a percentage of assets? A. Bid-ask spread. B. Expense ratio. C. Sales charge, low D. D. Commission. Answer, B. Expense ratio. The expense ratio represents the annual operating costs of a mutual fund, including management fees, administrative fees, and other operating expenses, expressed as a percentage of the fund's average net assets. This ratio is deducted directly from the fund's assets and impacts the investor's overall return. Sales charges, loads, are paid when buying or selling shares, while commissions are typically associated with individual stock trades. Question 25. When a company repurchases its own shares in the open market, these shares are referred to as A. Authorized shares. B. Outstanding shares. C. Issued shares. D. Treasury stock. Answer, D. Treasury stock. When a company buys back its own previously issued shares, these shares become treasury stock. Treasury stock is issued stock that is no longer outstanding, meaning it does not carry voting rights and does not receive dividends. Companies often repurchase shares to reduce the number of outstanding shares, which can boost earnings per share or to have shares available for employee stock options. Understanding treasury stock is important for analyzing a company's capital structure. Question 26. Which of the following typically has the longest maturity at issuance? A. Treasury bills. B. Commercial paper. C. Treasury notes. D. Certificates of deposit, CDs. Answer, C. Treasury notes. Treasury notes, T-notes, are intermediate-term debt securities issued by the U.S. Treasury, with maturities ranging from 2 to 10 years. In contrast, Treasury bills, T-bills, have maturities of 1 year or less. Commercial paper typically matures in 270 days or less, and certificates of deposit, CDs, can vary but are often short to medium term, typically up to 5 years. Therefore, among the choices, Treasury notes generally have the longest maturity at issuance. Question 27. In a limited partnership, which partner typically has unlimited liability? A. Limited partner. B. General partner. C. Silent partner. D. All partners have unlimited liability. Answer, B. General partner. In a limited partnership, the general partner, GP, is responsible for managing the partnership and assumes unlimited personal liability for the partnership's debts and obligations. Limited partners, LPs, on the other hand, contribute capital but have limited liability, meaning their potential losses are restricted to the amount of their investment. This structure offers a balance between active management and passive investment with varying risk profiles. This clear distinction in liability is a core characteristic of limited partnerships. Question 28. Which rule primarily governs the sales practices and suitability requirements for recommendations made by broker-dealers to their retail customers? A. Regulation T. B. Rule 144. C. Regulation Best Interest, Reg BI. D. Blue Sky Laws. Answer, C. Regulation Best Interest, Reg BI. Regulation Best Interest, Reg BI, is a FINRA rule that establishes a best interest standard of conduct for broker-dealers and their associated persons when making recommendations to retail customers of any securities transaction or investment strategy. It requires firms to act in the best interest of their customers and address potential conflicts of interest. While other rules are relevant to the securities industry, Reg BI specifically targets the sales practices and suitability requirements for retail customers. Question 29. An investor is concerned about the potential loss of purchasing power due to rising prices. This concern relates to which type of risk? A. Interest rate risk. B. Liquidity risk. C. Inflationary risk. D. Reinvestment risk. Answer, C. Inflationary risk. Inflationary risk, also known as purchasing power risk, is the risk that the value of an investor's assets or the income produced by them will decline in real terms due to a rise in the general price level of goods and services. If inflation outpaces investment returns, the investor's money will buy less in the future. This risk is particularly relevant for fixed-income investments, where the future purchasing power of fixed interest payments and principal can erode over time. Question 30. A margin account allows an investor to A. Trade only options contracts. B. Buy securities by borrowing money from their broker-dealer. C. Invest only in mutual funds and ETFs. D. Execute trades without a valid trading authorization. Answer, B. Buy securities by borrowing money from their broker-dealer. A margin account allows an investor to borrow money from their broker-dealer to purchase securities, thereby increasing their purchasing power and potentially amplifying returns, or losses. The securities purchased serve as collateral for the loan, and the investor must maintain a minimum equity level in the account. While margin accounts offer leverage, they also introduce increased risk and interest expenses on the borrowed funds, requiring careful consideration by investors. Question 31. Which of the following is characteristic of a tender offer? A. A company offering new shares to the public for the first time. B. An offer to existing shareholders to buy back their shares at the current market price. C. An offer by a company or an outside investor to buy outstanding shares from existing shareholders, usually at a premium. D. A stock dividend paid to shareholders. Answer, C. An offer by a company or an outside investor to buy outstanding shares from existing shareholders, usually at a premium. A tender offer is a public offer made by a company or an outside investor to purchase a substantial percentage of another company's outstanding shares from its existing shareholders, typically at a price higher than the current market value. This strategy is often employed in an attempt to gain control of the target company. It differs from an IPO, initial public offering, or a standard share repurchase by the issuer, as it is a direct solicitation to shareholders to sell their stock. Question 32. An investor purchasing a call option has the A. Obligation to buy the underlying asset. B. Right to sell the underlying asset. C. Right to buy the underlying asset. D. Obligation to sell the underlying asset. Answer, C. Right to buy the underlying asset. Purchasing a call option gives the buyer the right, but not the obligation, to buy a specified number of shares of the underlying asset at a predetermined price, the strike price, on or before a specific expiration date. Investors buy call options when they anticipate the price of the underlying asset will increase. The maximum loss for the buyer of a call option is limited to the premium paid for the option. Question 33. Which of the following would be considered a self-regulatory organization, SRO? A. The Securities and Exchange Commission, SAC. B. The Federal Reserve Board. C. The Financial Industry Regulatory Authority, FINRA. D. The Department of Treasury. Answer, C. The Financial Industry Regulatory Authority, FINRA. The Financial Industry Regulatory Authority, FINRA, is the largest independent self-regulatory organization, SRO, for all securities firms doing business in the United States. SROs are non-governmental organizations that have been given authority by the SEC to enforce industry standards and regulations on their members. The SEC is a government agency, and the Federal Reserve Board and Department of Treasury are government bodies, not SROs. Understanding the role of FINRA as an SRO is fundamental to understanding securities industry oversight. Question 34. A customer who wishes to receive electronic delivery of documents from a broker-dealer must A. Provide an oral consent to the broker-dealer. B. Be able to access electronic documents and provide written consent. C. Not be able to access physical mail. D. Provide a signed notarized affidavit. Answer, B. Be able to access electronic documents and provide written consent. For a customer to receive electronic delivery of documents, FINRA and SEC rules generally require two conditions. The customer must demonstrate the ability to access electronic documents, e.g., have an email address and internet access, and must provide affirmative written consent to receive documents electronically. Oral consent is typically not sufficient, and the ability to access physical mail is irrelevant. Question 35. Which statement accurately describes the pricing mechanism of an open-end mutual fund compared to a closed-end fund? A. Open-end funds trade at a premium or discount to NAV, while closed-end funds always trade at NAV. B. Open-end funds trade at NAV, while closed-end funds can trade at a premium or discount to NAV. C. Both open-end and closed-end funds always trade precisely at their net asset value, NAV. D. Neither open-end nor closed-end funds have a net asset value, NAV, as they are not publicly traded. Answer, B. Open-end funds trade at NAV, while closed-end funds can trade at a premium or discount to NAV. Open-end mutual funds are bought from and sold back to the fund company at their net asset value, NAV, which is calculated once per day at market close. In contrast, closed-end funds issue a fixed number of shares that trade on stock exchanges like regular stocks, and their market price can fluctuate based on supply and demand, often leading to them trading at a premium or discount relative to their NAV.